Welcome to session 5, the financial system. The outline of the session is given here. Key components of the financial system, functions of the financial system, financial instruments or assets, financial intermediaries or institutions, financial markets, equity market, debt market, derivatives market and forex market, financial market returns, growth and trends in the Indian financial system, global financial system, finance and civilization. The key components of the financial system are financial instruments, primary instruments such as equity shares and bonds, secondary instruments such as mutual fund units and insurance policies, financial institutions such as banks, development financial institutions, insurance companies, mutual funds and others, financial markets such as equity market, debt market, money market, derivatives market and forex market, financial services such as investment banking, depositories and custodians, credit rating, factoring and forfeiting, financial regulators like Reserve Bank of India and SEBI. The financial system forms the core of a modern economy. The principal entities in the financial system are suppliers of funds, demanders of funds, financial institutions, and financial markets. Suppliers of funds include individuals, businesses, and governments. Demanders of funds likewise include individuals, businesses, and governments. Suppliers of funds provide funds to demanders of funds through two major channels: financial institutions and financial markets. The key financial institutions are commercial banks, insurance companies, mutual funds, provident funds, non-banking financial companies. Suppliers of funds provide funds to financial institutions. In return, they get deposits or shares of these institutions. Financial institutions provide funds to demanders of funds. In return, they receive loan obligations. Suppliers of funds provide funds to financial markets. In return, they get financial securities. Financial markets provide funds to demanders of funds. In return, they get financial securities. The story doesn't end there. In addition to providers of funds, demanders of funds, financial institutions, and financial markets, there are several other players in the financial system, such as regulators, investment bankers, auditors, credit rating agencies, equity research analysts, and providers of information services. The principal regulators in India are Reserve Bank of India, Securities and Exchange Board of India, Insurance Regulatory and Development Authority, Pension Funds Development and Regulatory Authority, and Ministry of Corporate Affairs. The primary role of regulator is to maintain surveillance over various players in the financial system, define the rules of the game, impart stability to the financial system, and inspire confidence among savers and investors. Investment bankers connect companies with investors. Auditors offer an opinion on the quality of financial statements. Credit rating agencies provide an opinion on the creditworthiness of debt instruments. Equity research analysts provide recommendations on equity stocks. Providers of other information services help investors with relevant and useful information. If we look at all the players in the financial system, financial institutions, financial markets, regulators, so on and so forth, they are trying to address two basic issues in a modern economy: issues of informational asymmetry and agency problem. Managers know much more about the prospects of the company than investors know. Managers have an informational advantage and they can misrepresent the situation of the company in order to derive benefit from investors. Managers are the agents of investors. Investors are the principals. There is a principal agency relationship. Managers are likely to misbehave. Managers are not likely to fully subserve the interest of agents. So these two problems, which are pervasive in a modern economy, are the problems which are sought to be addressed collectively by all the players, mechanisms, participants, services, and regulation of financial system. The financial system performs several important functions in a modern economy. Payment system. Banks are the pivot to the payment system. Imagine what would happen if banks stopped functioning. The economy would be partially paralyzed. Pooling of household resources. The financial system pools resources from hundreds of millions of households and directs them to various possible uses. Transfer of resources across one's lifetime. The financial system enables people to save now and consume later, or consume now and save later. It facilitates life cycle allocation of resources. Risk management. The financial system provides mechanisms for risk management. The important mechanisms are hedging, insurance, and diversification. Price information for decentralized decision making. The financial markets provide information which facilitates decentralized decision making. Dealing with incentive problems. We have learned that incentive problems are pervasive in modern economies, and the financial system has ways and means of mitigating the incentive problem. Key elements of a well-functioning financial system. 1. A strong legal and regulatory environment. 2. Stable money. Stable money can be achieved when inflation is controlled. 3. Sound public finances and public debt management. 4. Sound banking system. 5. Well-functioning securities market. 6. A reliable information system. Financial instruments or assets are intangible assets that represent claims to future cash flows. The terms financial asset, instrument, or security are used interchangeably. Securities are of two kinds, primary and secondary. Examples of primary securities are a 10-year bond issued by Government of India carrying an interest of 7%. This bond would earn an interest of 7% annually and mature after 10 years. Equity shares issued by TCS. Examples of secondary securities are time deposits with banks, mutual fund units, insurance policies. India has a wide array of financial intermediaries or institutions. At the apex is the Reserve Bank of India. There are various kinds of financial intermediaries as shown in this diagram. Commercial banks, public financial institutions, insurance companies, other public sector financial institutions, mutual funds, and non-banking financial corporations. Commercial banks are perhaps the most important of financial intermediaries. Commercial banks are divided in two broad categories. Public sector banks such as State Bank of India, Canara Bank, private sector banks such as HDFC Bank and ICICI Bank. Traditionally, public sector banks dominate the banking space. In the last 2 decades, private sector banks have garnered a significant share of the banking sector, and on an incremental basis, they are garnering almost 80% of deposits thanks to better management and greater dynamism and entrepreneurship showed by these banks. Public financial institutions can be divided into two broad categories. All India institutions such as Exim Bank and Power Finance Corporation, state level institutions such as state financial corporations and state industrial development corporations. The insurance sector may be divided into three broad categories. Life Insurance Corporation, which has been the traditional behemoth in life insurance, which continues to be a giant in the insurance space. General Insurance Corporation of India, a government-owned entity, is in the general insurance business. Private sector insurance companies have emerged as an important force in recent decades. Other public sector financial institutions include Post Office Savings Bank, NABARD and NHB. Post Office Savings Banks has branches all over the country and enables hundreds of millions of small savers to participate in the small saving schemes of Government of India. NABARD is National Bank for Agriculture and Rural Development. It is dedicated to agriculture and rural development. National Housing Bank is dedicated to the housing sector. Mutual funds may be divided into public sector mutual funds such as State Bank of India mutual fund and private sector mutual funds such as HDFC mutual fund. Traditionally, public sector mutual funds dominated the mutual fund space, but in the last 2 decades, private sector mutual funds have become more important. Non-banking financial corporations include public sector firms and private sector firms. A very important segment of non-banking financial corporations is the housing finance companies such as HDFC. Rationale for financial intermediaries. Diversification. When you participate in a mutual fund scheme, you get the benefit of diversification in a cost-efficient manner. Lower transaction costs. Mutual funds buy and sell in large quantities, so they enjoy lower transaction costs, which are passed on to their investors. Economies of scale. Organizations like LIC have large volumes of business, so they enjoy economies of scale, which are somehow passed on to their policy holders. Confidentiality. When you share information with a bank or financial institution, the information is supposed to be kept confidential. The principal regulatory agencies in India are Reserve Bank of India, which regulates the banking sector and non-banking financial companies; Securities and Exchange Board of India, which regulates the capital market; Insurance Regulatory and Development Authority, which regulates the insurance sector; Pension Funds Development and Regulatory Authority, which regulates the pension sector. Financial markets. A financial market is a market for creation and exchange of financial assets. Financial markets play a very pivotal role in allocating resources in the economy by performing three important functions. Price discovery. Financial markets discover price. What do we mean by saying that the market discovers price? We mean that the market finds a price at which demand and supply are balanced. Of course, prices change all the time in response to changing demand and supply conditions. Liquidity. Financial markets provide liquidity. An asset is liquid when you can buy or sell the asset at a price close to the prevailing market price and close the transaction or settle the transaction in 2 to 3 days. Lower cost of transactions. Financial markets have dramatically reduced the cost of transactions. Imagine what would happen if there is no organized stock exchange. As a potential buyer, you will have to find a potential seller, negotiate price, close the transaction, take counterparty risk. All this is virtually eliminated. Search and information costs are dramatically reduced with well-functioning financial markets. We can classify financial markets along several dimensions: nature of claim, maturity of claim, seasoning of claim, timing of delivery, organizational structure. Nature of claim. A debt market is a market where debt instruments are traded. An equity market is a market where equity instruments are traded. Maturity of claim. Money market is a market where short-term debt instruments are traded. Capital market is a market where long-term debt instruments and equity instruments are traded. Seasoning of claim. Primary market is the market where securities are issued for the first time. Secondary market is a market where outstanding securities are traded. Of course, the secondary market is much bigger than the primary market. Timing of delivery. Cash or spot market is a market where a trade is consummated within a day or two. Forward or futures market is a market where a trade is consummated at some point of time in future. Organizational structure. Exchange traded markets are markets which are very well organized and regulated. In these markets, products are standardized and the entire risk management is done by the exchange. Over-the-counter market is a market where two parties enter into a bilateral transaction. Of course, in these transactions, there is always a counterparty risk. Financial markets may be broadly divided into four types: equity market, debt market, derivatives market, forex market. Debt market in turn has three segments: common securities market, corporate bond market, money market. Derivatives market has two segments: futures market, options market. Forex market has two segments: spot market and forward market. We will discuss each of these markets in some detail. Equity market, our discussion of equity market will cover primary market, secondary market, equity returns, equity market indices, and market efficiency. There are many participants in the securities market: regulators, stock exchanges, listed securities, depositories, brokers, foreign portfolio investors, merchant bankers, primary dealers, mutual funds, custodians, registrars, underwriters, bankers, debenture trustees, venture capital and private equity funds, credit rating agencies, and others. Equity market has two segments: primary market, where new issuances are made in different ways, and secondary market, where outstanding securities are traded. There has been a veritable metamorphosis of the secondary market. We'll examine these changes and also learn about different kinds of equity market indices. There are three ways in which a company can raise money in the primary equity market: public issue, rights issue, private placement. A public issue involves selling securities to the general investing public through a prospectus. A rights issue entails selling securities to existing shareholders on a pro rata basis through a letter of offer. A private placement involves selling securities to a group of select investors. Here is an example of a public issue. Alibaba raised $25 billion in 2014 on NASDAQ, an exchange in the US. A public issue may be made at a fixed price, or the price may be obtained through a book building process. In book building, the issue price is not fixed in advance as is done in a fixed price offer, but is determined through a bidding process. A rights issue involves selling securities in the primary market by issuing rights to existing shareholders. In 2020, Reliance Industries Limited raised 53,000 crore rupees through a mega rights issue. Under the company law, additional equity capital has to be offered in the first instance to the existing shareholders on a pro rata basis. If a company wants to deviate from this, it has to get the approval of shareholders by way of a special resolution. A private placement is an issue of securities to a select group of persons not exceeding 200. There are two ways in which private placement is made: preferential allotment and qualified institutional placement. Preferential allotment is typically made to promoters and strategic investors. For example, Reliance Jio made a preferential allotment in 2020 to Facebook, Google, and others. Qualified institutional placement is placement of securities with a group of qualified institutional buyers. The primary market has witnessed important changes, particularly after the formation of SEBI in the last 25 to 30 years. Free pricing: in the pre-SEBI era, pricing was regulated by the Ministry of Finance. After the formation of SEBI, companies have been given freedom in pricing securities. Freedom in designing instruments: in the pre-SEBI era, there were a lot of restrictions on designing instruments. Now companies have tremendous freedom in designing instruments. Issue of capital and disclosure requirements: a lot of emphasis has been placed on disclosure, and SEBI has elaborate guidelines on capital and disclosure requirements. Efficient delivery mechanism: earlier securities were issued in physical form, now securities are issued in dematerialized form. Book building: earlier securities were offered at a fixed price, now book building has become the dominant mechanism. In the secondary market, the most important development has been the establishment of National Stock Exchange in 1994. Within a short period, it emerged as the largest stock exchange, surging ahead of the Bombay Stock Exchange and eclipsed most of the regional stock exchanges. The National Stock Exchange is a ringless national comprised exchange. The NSE has opted for an order-driven system. Buyers and sellers can place their orders on the platform of NSE. Orders are matched on a price time priority basis. This means that a buy order for a higher price is given preference over a buy order at a lower price, and a sell order at a lower price is given preference over a sell order at a higher price. When two orders are at the same price, the order which has been placed earlier is given priority. That is the import of price time priority. All trades on NSE are guaranteed by the National Securities Clearing Corporation. In a way, National Securities Clearing Corporation interposes itself between the buyer and the seller and guarantees all trades, so there is no counterparty risk whatsoever. The system followed by NSE may be referred to as the Electronic Limit Order Book System or ELOB system. On the screen of NSE, all buy orders and sell orders which are pending are displayed. You can find out how much quantity people are willing to buy at various prices and how much quantity people are willing to sell at various prices. This information is extremely useful for participants in the market. The Mumbai Stock Exchange, also called BSE, was set up in 1875. It has a long and checkered history. Historically, BSE followed the open outcry system of trading. In an open outcry system, buyers and sellers assemble on the trading floor, resort to shouting and signaling. It's a very inefficient and chaotic way of trading, but a very colorful and vibrant way of trading. When NSE adopted the screen-based system in 1994, BSE followed suit in 1995. For a while, the BSE had adopted a code-driven system and an order-driven system. In a code-driven system, jobbers play an important role. Later, they switched completely to the order-driven system to conform to the practice of NSE because NSE had surged ahead. There has been a veritable transformation of the secondary market in India in 1990s. Screen-based trading supplanted the traditional open outcry system. Dematerialization did away with physical securities. Rolling settlement was introduced wherein the settlement is done within 2 days of the trade. Earlier, the settlement cycle was a fortnight. FNO trading was introduced in 2000. Thanks to these changes, there was a metamorphosis of the secondary market in India. No other country experienced such a rapid transformation in such a short time. The Indian secondary market can claim to be as modern as the secondary market anywhere else in the world. Thanks to the introduction of screen-based trading and dematerialization, transaction costs have fallen sharply in India. In mid-1993, trading costs were about 3.75%, settlement costs were about 1.25%, transaction costs were about 5%, along with counterparty risk. Today, trading costs have fallen to 0.4% or so, settlement costs are barely 0.1%, and there is no counterparty risk. As a result, the total cost is about 0.5%. Algorithmic trading or algo trading is based on a program written by an analyst with predetermined parameters for jobbing, arbitrage trading, and so on. It is a fully automated process with no human intervention. Its proponents claim that algorithmic trading, also called program trading, improves the chances of success. To sum up the changes in secondary market, trading has been computerized, trading costs have come down, transparency has been enhanced, markets have become integrated, globalization has been encouraged, management of exchanges has been strengthened, speculation has heightened, and settlement has shifted to electronic mode. The thrust of reforms has been in these directions: market orientation, deregulation, automation, globalization, institutionalization. It must be emphasized that the metamorphosis of the equity market was due to the economic reforms of the early 1990s when four new institutions were created: Securities and Exchange Board of India, National Stock Exchange, National Securities Clearing Corporation, National Securities Depositories Limited. Indeed, globally, the stock market has transformed in the last 25 years. Human suppliers of liquidity like the Nasdaq dealers and NYSE specialists have been replaced by algorithmic market making. Stocks that once traded on a single venue now trade across 12 exchanges and a multitude of alternative trading systems. New venues like dark pools and new participants like high frequency traders have emerged to take on prominent roles. How is the rate of return on an equity stock measured? The rate of return on equity stock for a given year is equal to dividend yield plus capital gains yield. Dividend yield is defined as cash dividend divided by beginning price and capital gains yield is ending price minus beginning price divided by beginning price. To illustrate, suppose the beginning price of a share is rupees 100, the investor gets a dividend of rupees 2 at the end of the year, the ending price is rupees 110. So the rate of return on this equity stock is dividend yield, which is 2%, plus capital gains yield, which is 10%. So the total rate of return is 12%. We looked at the rate of return over 1 year. How do we calculate the average annual rate of return over a multi-year period? There are two popular measures for calculating the average return: arithmetic mean or arithmetic average, and geometric mean or geometric average. Arithmetic mean is defined as R bar equals summation of Ri, I ranging from 1 to n divided by n, where Ri is the ith value of the total return for year I, and I varies from 1 to n, and n is the number of total returns. To illustrate, suppose the total returns from stock A over a 5-year period are as follows: year 1 total return 19%, year 2 total return 14%, so on and so forth. The arithmetic mean works out to the sum of all of these divided by 5, so it is 9.6%. The geometric mean or geometric average is defined as follows: Gm is equal to 1 plus R1 multiplied by 1 plus R2, so on and so forth, multiplied by 1 plus Rn, the entire product raised to the power of 1 by n minus 1, where Gm is a geometric mean return, Ri is the total return for period I varying from 1 to n, and n is the number of time periods. 1 plus R1 is called the return relative. To illustrate, consider the total return and return relative for stock A over a 5-year period. Year 1 total return 19%, return relative is 1.19. Year 2 total return 14%, return relative is 1.14, so on and so forth. The geometric mean of the returns over the 5-year period is 1.19 multiplied by 1.14 multiplied by 1.22, so on and so forth. The entire product raised to the power of 1 by 5 minus 1. So 1.089 minus 1 equals 0.089 or 8.9%. So we found that the arithmetic mean was 9.6% and the geometric mean is 8.9%. Typically, geometric mean is lower than the arithmetic mean. The geometric mean and arithmetic mean are identical when returns remain constant. As long as there is variability of returns, geometric mean is less than the arithmetic mean.
It is instructed to look at the data of Nifty index from 1990 to 2022. At the end of 1990, Nifty was 331. By the end of 1991, it was 559, which means it rose by nearly 69% over 1 year period. This represents the capital gains return, to which we will add the dividend yield a little later. By 92 end, it rose to 761, providing a return of 36%. 93 was also a buoyant year, so by the end of 1993, Nifty was 1043. Thereafter, Nifty hardly moved for 9 years. It fluctuated a great deal along the way. If you look at the level of Nifty at the end of 1993, it was 1043, and the level of Nifty at the end of 2002, it was 1094. So for a 9-year period, it barely moved, with a lot of fluctuations along the way. Then, a very buoyant market lifted Nifty substantially for the next 5 years, from 2003 to 2007, which were the booming years when Nifty provided stellar returns. In 2008, the market collapsed by nearly 50%. It recovered substantially in 2009, and thereafter, Nifty has moved by about 10 to 11% per year over the next 10 to 12 years. So you find a very interesting pattern of Nifty when you look at the movement of Nifty from 1990 to 2022. Nifty provided excellent returns for 3 years and then later for 5 years. In other periods, it provided very meager returns with a lot of fluctuations. That is the nature of beast called the equity market. Based on the above exhibit, we can calculate the arithmetic mean return and the geometric mean return over the 32-year period. The return for 1991 is 68.8%. We have calculated the returns for other years in the same manner. Given these annual return observations, the arithmetic mean return is sum of the annual returns divided by number of observations. If we add all these numbers and divide by 32, because we have 32 observations, the arithmetic mean return works out to be 17.37%. As far as the geometric mean return is concerned, we have to multiply the return relative for 32 years. The return relative for the first year 1991 is 1.6884. The return relative for the last year 2022 is 1.0433. Multiply all the return relatives, whatever is the product, raise it to the power of 1 by 32 and then subtract 1. We get geometric mean return of 13.32%. This represents only the return on account of capital value changes. What about the dividend yield? The dividend yield during this period was perhaps 2 to 2.5%. If we assume a figure of 2.25% for the sake of argument, we have to add that number to 13.32%, so we get a total return close to 15.55%. However, we have to recognize one reality. The PE multiple of Nifty at the beginning of 1990 was much lower to what it was at 2022. There was a significant expansion of PE multiple, which may have contributed to a return of 3% or thereabout. So this is the factor that we cannot ignore. From the figure of 15.5%, we may have to subtract this figure to get an idea about what can be realistically estimated going forward.
Investors, policymakers, economists, and others are interested in knowing what is happening to the market as a whole. In order to gauge the market movement, they look at some index or the other. The two most popular indices in India are Sensex and Nifty. Before we look at Sensex and Nifty, we need to understand how stock market indices are calculated. There are different ways of calculating a stock market index. The three most popular methods for calculating a stock market index are price weighted index, value weighted index, and equal weighted index. An index is based on a sample of stocks drawn from the universe of listed stocks. This sample may consist of 30 stocks, 50 stocks, 100 stocks, or whatever. The method of construction remains the same irrespective of the sample is 30 or 50. Since we are interested in learning about the method of construction, we'll keep our sample very small. We'll look at a sample of just two stocks, A and B. The initial price or the base year price of A is rupees 25 per share. The initial price or base year price of B is rupees 100 per share. The final price or the current price of stock A is rupees 30 per share. The final price of stock B is rupees 90 per share. The number of outstanding shares of A is 20 million. The number of outstanding shares of B is 1 million. The initial value of A and B is shown in this column. Initial value of A is rupees 25 multiplied by 20 million, so it is rupees 500 million. The initial value of B is rupees 100 multiplied by 1 million, so it is rupees 100 million. So the initial value of A and B put together is rupees 600 million. The final value of stocks A and B is shown here. Stock A is appreciated from rupees 25 to 30, so the final value appreciates from rupees 500 million to rupees 600 million. Stock B suffers a decline of 10%, so the final value is rupees 90 million. The total of A and B in the final year is rupees 690 million. Price relative is defined as final price divided by initial price multiplied by 100. 30 rupees divided by 25 rupees multiplied by 100 is 120. 90 rupees divided by 100 rupees multiplied by 100 is 90 rupees. Price weighted index assumes that the investor buys one share of each company. If the investor buys one share each of A and B, he would invest 125 rupees in the base year, and his investment in the final year would be worth 120 rupees. So an investor who invests 125 ends up with 120. 120 divided by 125 multiplied by 100 is 96. So essentially the investor suffered an erosion in value of 4%. Value weighted index reflects the collective experience of all investors. What happens to all investors in A and B? All investors in A and B would invest rupees 600 million in the base year, and this investment would grow in value to rupees 690 million in the final year. So 690 divided by 600 multiplied by 100 is 115. So collectively, investors in A and B enjoy an appreciation of 15%. Equal weighted index assumes that the investor allocates equal funds across all stocks. Suppose an investor has rupees 200 to invest, and he invests rupees 100 in stock A and rupees 100 in stock B. His investment of rupees 100 in stock A will fetch him 4 shares. His investment of rupees 100 in stock B will fetch him 1 share. 4 shares in A would be worth 120 rupees in the final year. One share of B would be worth rupees 90 in the final year. So 120 plus 90 would be the value of his portfolio in the final year. His initial investment is 200 rupees. So the equal weighted index is 210 divided by 200 multiplied by 100. It works out 205, which means an investor who invests an equal sum of money in each of these two stocks will enjoy an appreciation of 5%. By the way, Sensex and Nifty are both value weighted indices. To sum up, a value-weighted index reflects the collective experience of all investors. A price-weighted index reflects what happens if you buy one share of each company. An equal-weighted index reflects what happens when you allocate your funds equally across all the stocks. Sensex, the BSE sensitive index, popularly called the Sensex, reflects the price movement of 30 sensitive shares. The base year is 78.79. The base value is 100. It is a value weighted index. It is constructed on the basis of free float market cap rather than full market cap. What does this mean? Suppose the full market cap of TCS is rupees 10 lakh crores and Tata Sons owns 70% equity in TCS. Then the free float market cap is only rupees 3 lakh crores, and that will be taken into account in constructing the value weighted index. Sensex is very prominent in financial news. We hear about it all the time. They say Sensex has crossed 50,000. Sensex has fallen by 2%. Sensex has become a barometer of national financial health. I was once involved in the revision of Sensex after a 2-hour meeting where we had animated discussion. I could not refrain myself from commenting, Sensex seems to have more of sex and less of sense. Nifty. The Nifty reflects the price movement of 50 stocks selected on the basis of market cap and liquidity. The base period for Nifty is the closing price on November 3, 1995, exactly a year after the formation of National Stock Exchange. The base value of the index has been set at 1000. It is a value weighted index. It is a market cap weighted index using free float market cap. The most popular stock market indices around the world are Dow Jones. This is a price weighted index based on 30 stocks. S&P 500. This is a value weighted index. Nasdaq. This is a value weighted index. Nikkei 225. This is a price weighted index. FTSE 100. This is a value weighted index. The key market indicators are aggregate market cap to GDP, aggregate price earnings multiple, aggregate price to book multiple. Aggregate market cap to GDP is defined as the sum of the market cap of all companies listed on the exchanges divided by gross domestic product. If, say, the sum of the market cap of all companies listed on the exchanges is 160 lakh crores and GDP is 210 lakh crores, then aggregate market to GDP is 0.76. Aggregate P multiple is defined as aggregate market cap divided by aggregate corporate earnings. Here we look at earnings of all companies listed on the exchanges and add them. For example, if earnings of Reliance are 50,000 crore rupees, earnings of TCS are 35,000 crore rupees, so on and so forth. We add all the earnings and we get aggregate corporate earnings, just the way we have aggregate market cap, which is the sum of the market cap of all companies listed on the exchanges. If Reliance has a market cap of 13 lakh crores, TCS has a market cap of 11 lakh crores, so on and so forth, all those numbers are added to get the aggregate market cap. Now, P multiple is calculated on a trailing basis as well as a forward basis. When P multiple is calculated on a trailing basis, we look at the actual aggregate corporate earnings for the year which has just rolled by. If P multiple is calculated on a forward basis, we look at projected earnings for the following year. So there is an element of speculation there. Price to book multiple is defined as aggregate market cap divided by aggregate corporate net worth. Aggregate corporate net worth is the sum of the net worth of all companies listed on the exchanges. If aggregate corporate net worth is 50 lakh crores and aggregate market cap is 160 lakh crores, we say that price to book multiple for the market as a whole is 3.2. Now we discuss a very important idea in finance, market efficiency. An efficient market is one in which the market price of a security is the least biased estimate of its intrinsic value. In other words, it is the best proxy of the intrinsic value. Remember, market price is observable because market price is what we see on a daily basis in the market. This is a price which is determined by demand and supply forces in the marketplace. Intrinsic value is not observable. Technically, intrinsic value of a security is the present value of benefits that are derived from that ownership of that security. For example, the intrinsic value of an equity share is the present value of dividends receivable from the ownership of the share from here to eternity. Intrinsic value cannot be observed. Intrinsic value can only be estimated. Market price is believed to be a very good proxy for intrinsic value if the market is efficient. Market efficiency is defined in relation to information that is reflected in security prices. Eugene Fama, a Nobel laureate in economics, distinguishes three levels of market efficiency: weak form efficiency, semi-strong form efficiency, and strong form efficiency. What does Eugene Fama mean by weak form efficiency, semi-strong form efficiency, and strong form efficiency? Weak form efficiency means that current prices reflect all historical market data. Historical market data includes price data, volume data, and data relating to options and futures. If current prices reflect all historical market data, technical analysis is a futile exercise. Technical analysis assumes that analysis of historical market data enables one to project prices, but if the market is efficient in this sense, then technical analysis is a worthless exercise. Semi-strong form efficiency means that prices reflect all public information. All public information is a wider set of information which includes historical market data. In addition, it includes information found in annual reports, equity research reports, information put out by various research agencies and governmental entities. It includes a large amount of information which is in public domain. Semi-strong form efficiency suggests that profit-hungry investors will get information from publicly available sources and reflect that information almost instantaneously in stock prices. Hence, fundamental analysis is a worthless proposition. Strong form efficiency is the highest form of efficiency. It assumes that prices reflect information which is both public and private. What is private information? Private information is information available to the CEO and some trusted lieutenants. This is what also called as insider information. This form of efficiency is unlikely to be true because we know that insiders often benefit at the expense of others. If we look at these three forms of efficiency, we find that the strong form efficiency subsumes semi-strong form efficiency, which in turn subsumes weak form efficiency. According to Henry Schleifer, any of the following three conditions will lead to market efficiency: investor rationality, independent deviation from rationality, effective arbitrage. If investors are rational, they form reasonably accurate opinion about the impact of various events and developments, so their actions will ensure that market prices are good proxies of intrinsic values. Even if investors are not rational and form incorrect opinions, as long as the errors of investors are independent, the market can still be rational. In this situation, the collective wisdom of the market is far greater than the wisdom of individual investors. Effective arbitrage. Even if investor errors are correlated, as long as effective arbitrage takes place, market prices will be good proxies of intrinsic values. To understand how effective arbitrage may occur, let us assume that the market can be divided into two kinds of players: irrational amateur investors and rational professional investors. Irrational amateur investors may become excited about stocks and move the prices to an irrationally high level, or they may become very pessimistic and drive prices far below intrinsic values. When the actions of irrational amateur investors cause significant deviation of prices from intrinsic values, rational professional investors will find wonderful opportunities for effective arbitrage. Through their action, they will ensure that prices come back to levels which are more rational and reasonable. The rational finance model argues that the market is efficient. Proponents of behavioral finance, however, challenge this assumption. According to them, the noise trading resorted to by irrational amateur investors is not adequately countered by arbitrageurs. Why? There are limits to arbitrage because arbitrageurs may not have sufficient funds or may not have sufficiently long time horizons. Thanks to these limitations on arbitrage, the market is often inefficient. This means prices can deviate from intrinsic values for significant amounts of time. Many investment practitioners are more sympathetic toward behavioral finance paradigm. They believe the market moves in a cycle in response to changing investor emotions or sentiments. Optimism, excitement, thrill, and euphoria can lead to irrational exuberance and elevated stock prices. This is likely to be followed by anxiety, denial, fear, desperation, panic, capitulation, and despondency, leading to irrational despondency and highly depressed prices. This is likely to be followed by hope, relief, and optimism, and another cycle begins. If we look at a cycle like this, we find that prices often deviate from intrinsic values under the influence of emotions. There are three segments of debt market: government securities market. This is the market for dated government securities, that is government securities which have an initial maturity of 2 years or more. Corporate bond market, there is a market for bonds issued by corporates. Money market is the market for short-term debt instruments such as treasury bills issued by Government of India and commercial paper issued by corporates. Government securities market understandably is the largest segment of the debt market, accounting for 2/3 of new issuances in the primary market. and over 80% of turnover in the secondary market. In the primary market, government securities are offered through an auction mechanism conducted on a weekly basis by Reserve Bank of India, which serves as the investment banker to the government. In the secondary market, the bulk of the trades take place in the over-the-counter market. Screen-based trading also has been introduced by Reserve Bank of India, but currently it doesn't account for a significant portion of trading. Primary market for corporate debt. Corporate bonds may be issued publicly or privately placed. Public issue of corporate bonds is done on a fixed price basis through an offer document which specifies a coupon, tenor, security and other terms. Private placement of corporate bonds is done mostly through a book-built issue to institutional investors. Presently, nearly 90% of corporate bonds in the primary market are privately placed. Secondary corporate bond market. Corporate bonds are listed and traded on the exchanges the way equity is traded. However, the secondary market for corporate bonds is largely an over-the-counter or OTC market. What does it mean? This means that these trades don't take place on the platform of an organized exchange. Rather, they take place by way of bilateral negotiations outside the exchange. Meager trading occurs on the platforms of NSE and BSE. The trading volumes reported on the wholesale debt market segment of the NSE are actually OTC trades that are merely reported to the exchange. Money market. Money market is the market for short-term debt funds. It comprises of the call and notice money market, repo market, and the market for debt instruments such as treasury bills and commercial paper that have an original maturity of less than 1 year. The money market does not exist in a specific physical location or follow a single set of rules or post a single set of prices. Rather, it represents a web of borrowers and lenders linked by telephones and computers dealing in short-term debt. Money market. Money market is a market for financial assets which are close substitutes for money. This is the market for overnight to short-term funds and instruments like treasury bills and commercial paper which have an original maturity of less than 1 year. It does not have a physical location like the stock market, but it is an activity conducted over telephones and computers. The main players in money market are Reserve Bank of India, Discount and Finance House of India, mutual funds, insurance companies, banks, corporate investors, NBFCs, state governments, provident funds, primary dealers, Securities and Trading Corporation of India, PSUs and NRIs. Money market is a wholesale market for short-term debt instruments. Its principal feature is honor and the creditworthiness of participants is important. Transactions are both secured and unsecured, that is without collaterals. Money market serves some important functions. It provides a balancing mechanism for evening out demand for and supply for short-term funds. It provides a focal point for central bank to intervene and influence the liquidity and general level of interest rates in the economy and plays a key role in monetary policy transmission to financial markets and real economy. The repo market is a very important segment of the money market. In a repo transaction, two parties exchange securities and cash with a simultaneous agreement to reverse the transaction after a given period. For example, A may sell a security for rupees 100 and promise to repurchase it at rupees 101 after 90 days. B, on the other hand, buys the security at rupees 100 from A and promises to sell it back at rupees 101 after 90 days. The party which lends securities or borrows cash is said to be doing the repo. In this case, A is said to be doing the repo because A is lending or selling the securities and borrowing cash, and the party which lends cash or borrows securities is said to be doing the reverse repo. In this case, B is said to be doing the reverse repo. Securitization. Securitization involves packaging a designated pool of assets such as mortgage loans, consumer loans, hire purchase receivables, and so on, and issuing securities which are collateralized or backed by the underlying assets and their associated cash flow stream. Securities backed by mortgage loans are referred to as mortgage-backed securities. Securities backed by other assets are called asset-based securities. Securitization has been a major innovation in finance in the last few decades. Corporate debt instruments are subject to default risk. They may default in paying interest or principal or both. To assess the default risk associated with debt instruments, credit rating is done. Now, credit rating is mandatory for almost all corporate debt issuances. Credit rating is done by independent credit rating agencies like CRISIL, CARE, ICRA, and Brickworks. CRISIL is the largest credit rating agency in India. It assigns ratings on a scale as shown in this column. It is an 8-point scale. Triple A means highest safety, double A means high safety, A means adequate safety, triple B means sufficient safety, double B means inadequate safety, B means susceptible to default, C means vulnerable to default, D means in default. Other credit rating agencies also use an 8-point scale. Their nomenclature may be slightly different, but the import is the same. Instruments which are rated triple B or above are considered as investment grade instruments. Instruments which are rated double B or below are regarded as speculative grade instruments. In popular parlance, they are called as junk bonds. Of course, issuers would like to call them as high yield bonds. What are the determinants of interest rates on debt instruments? The key determinants are inflation rate, maturity, default risk, collateral, special features. If the inflation rate is high, the nominal rate of interest would be high. If a debt instrument is denominated in dollars, the interest rate would be lower than a debt instrument denominated in Indian national rupees, because historically inflation rate in the US has been much lower than the inflation rate in India. Maturity. A debt instrument which has a shorter maturity is likely to carry an interest rate which is lower than a debt instrument of a longer maturity. For example, a commercial paper which has a maturity of 180 days issued by Tata Steel would have a lower interest rate compared to a 10-year bond issued by Tata Steel. Likewise, a 182 days treasury bill issued by Government of India would carry a lower rate of interest compared to a 10-year Government of India security. Default risk. If the default risk is perceived to be high, the nominal rate of interest would be high. If the default risk is perceived to be low, the nominal interest rate, other things being equal, would be low. Collateral. If the debt instrument is unsecured, it is likely to carry a high rate of interest. On the other hand, a secured debt instrument is likely to carry a lower rate of interest. Special features such as conversion feature. If a debt instrument is convertible into equity at the option of the investor, the interest rate on debt instrument tends to be lower. The key determinants of expected returns in an economy are productivity of capital, degree of uncertainty, time preferences, degree of risk aversion. If capital is employed more productively, expected returns are higher. Expected returns in the US have been higher than the expected returns in Russia because capital is employed more productively in the US compared to Russia. Degree of uncertainty. If the degree of uncertainty is very high, expected returns tend to be high. Time preferences. If investors are very myopic and short-sighted, then they may require a higher expected return from investment instruments which have a longer maturity. In other words, maturity premium would be higher. Degree of risk aversion. If investors have a high aversion for risk, then they may ask for a higher risk premium for investing in risky securities. The key interest rates in India as on 26 June 2020 were as follows. Bank rate. Bank rate is the rate at which Reserve Bank of India provides short-term loans to commercial banks. Repo rate is the rate at which commercial banks can borrow from Reserve Bank of India by selling securities with an agreement to repurchase them after some time. 364 days treasury bill rate is the rate at which treasury bills which have a maturity of 364 days are issued. Treasury bills are issued with an initial maturity of 91 days, 182 days and 364 days. Term deposit rate is the rate offered by commercial banks on term deposits. Yield on 10-year government bond is the yield to maturity on a 10-year Government of India security. Base rate is the rate which serves as a foundation on which commercial banks charge interest rates for various kinds of clients and uses. What is the relationship between nominal rate, real rate and inflation rate? The relationship between the three is defined by this equation. 1 plus real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate. Suppose the nominal rate is 10% and the inflation rate is 5%. Then 1 plus real rate is 1 plus 0.1 divided by 1 plus 0.05. It is 1.0476. So the real return is 1.0476 minus 1, which is 0.0476 or 4.76%. Approximately, real return is nominal return minus inflation rate. Let us turn our attention to the derivatives market. After a broad overview, we look at futures and options. A derivatives contract derives its value from the underlying asset. Derivatives are part of secondary market and no funds are raised through derivatives. Transactions in derivatives are typically settled by taking offsetting position in the same derivatives or cash settle at the time of expiry. There is no limit on the number of units transacted because there is no physical asset involved. Derivative markets are very liquid by their nature. Derivatives may be classified in two broad categories: financial derivatives and commodity derivatives. Commodity derivatives have been in existence in India for many years. Financial derivatives are of recent origin. Financial derivatives may be classified into two types: basic financial derivatives and complex financial derivatives. The basic financial derivatives are forwards, swaps, futures, options, warrants and convertibles. Derivatives serve two purposes. One, derivatives improve price discovery of the underlying asset. Two, derivatives facilitate risk management. The participants in the derivatives market may be classified into three types: hedgers, speculators and arbitrageurs. Hedgers are individuals and organizations who have risk exposure and they want to offset the risk by taking a position in the derivatives market. Speculators take risk in the hope of earning a return for taking risk. Arbitrageurs look for riskless profit opportunities. They simultaneously enter into two transactions in different markets when they see an arbitrage opportunity. India's tryst with derivatives began in 2000. In June 2000, index futures were introduced. These were followed by index options in June 2001. In July 2001, individual stock options were introduced. Finally, in November 2001, individual stock futures were introduced. Presently, index options account for the bulk of derivatives trading in India. They are followed by stock futures, index futures, and stock options. It appears that equity derivatives play an important role in price discovery. The futures and options segment of National Stock Exchange is a very vibrant and dynamic segment. It accounts for the bulk of turnover on NSE. Perhaps the trading volume on the F&O segment is 12 to 15 times greater than the trading volume on the cash segment. The F&O segment in turn has two components, the futures segment and the options segment. A futures contract is a standardized forward contract. An options contract gives the option holder the right to buy or a right to sell an asset in future at a price specified today. Futures contracts are standardized forward contracts. The differences between the two are shown here. Forward contracts are traded over the counter. Futures contracts are traded on an organized exchange. There is no secondary market for forward contracts. There is an active secondary market for futures contracts. The terms of a forward contract are negotiated bilaterally between the buyer and the seller. The terms of the futures contract are standardized and defined by the exchange. Most forward contracts end with physical delivery. Normally, no delivery takes place in a futures contract. The contract is offset by an opposite transaction. There is a credit risk in a forward contract. There is no credit risk in a futures contract because the clearing corporation of the exchange guarantees the contract. No collateral is usually posted in a forward contract. In a futures contract, a collateral has to be posted with the exchange. Further, the contract has to be marked to the market on a daily basis. There are few participants in forward contracts. There are many participants in futures contracts. In ordinary parlance, an option means a choice. In the world of finance, options have a very specific meaning. There are two kinds of options, calls and puts. A call option gives its buyer a right to buy something at a predetermined price by paying a premium. For example, you may enjoy a call option which entitles you to buy one share of Reliance Industries Limited at rupees 2,200 over the next 60 days. In order to enjoy this right, you have to pay a premium, and the premium as determined by market forces may be rupees 50. A put option gives its holder the right to sell. Just the way the buyer of a call option has to pay a premium, the buyer or holder of a put option also has to pay premium. Let us understand the features of option contracts from the point of view of the buyer and seller. Rights stroke obligations. Buyers have rights but no obligations. Sellers have only obligations, no rights. Call, right to buy, obligation to sell. Put, right to sell, obligation to buy. Premium, the buyer pays the premium, the seller receives the premium. Exercise, exercise is at the discretion of the buyer. Exercise cannot be influenced by the seller. Maximum possible loss, cost of premium paid by the buyer, unlimited losses, maximum possible gain, unlimited profits, price of premium, closing position if exchange traded. Buyer may exercise the option, may offset by selling the option in the market, or let the option expire worthless. Seller may assign the option to someone else. Seller may offset by buying option in the market. Seller keeps the full premium if the option expires. Let us turn our attention to the foreign exchange market. We look at the features, quotations, and international parity relationships. Features of the foreign exchange market. The foreign exchange market, or FX or forex market, is a global marketplace for exchange of national currencies against one another. It is virtually a 24-hour market spanning all time zones. The foreign exchange or forex market is the largest market with a daily turnover close to $7 trillion. The bulk of it, however, represents speculation. It is essentially an over-the-counter market. The major players are financial institutions, commercial banks, central banks, money managers, and hedge funds. Global corporations use forex markets for hedging currency risk relating to foreign transactions. Individuals account for a very small portion of trading. They are mainly speculators and day traders. Currency is traded in spot transactions, forward transactions, swaps, and option contracts. The symbols for some currencies are shown here: US dollar, euro, Japanese yen, British pound, Swiss franc, Indian rupee, Russian ruble, Chinese yuan, Turkish lira. The foreign exchange market in India is relatively small. Reserve Bank of India, banks and business firms are the key participants. RBI plays a key role in setting the day-to-day rates. RBI claims that it does not interfere with long-term movements, it only tries to moderate short-term fluctuations. Business firms can't resort to speculative transactions. In India, a system of direct quotes is followed. A direct quote is an exchange rate per unit of foreign currency quoted in terms of number of units of the domestic currency. A quotation provided by a bank or dealer consists of two prices separated by a hyphen or slash. The first price is the bid price. This is the price at which the dealer is willing to buy. The second price, the ask price. This is the price at which the dealer is willing to sell. An illustrative quotation is given below. USD INR spot 75.000 slash 75.540. This quotation means that the dealer will buy $1 for rupees 75 and will sell $1 for rupees 75.540. Forward rate quotation. In the foreign exchange market, forward transactions are also possible in which the rate is fixed today but the settlement is at some specified date in the future. Such rates are called forward rates. Banks normally quote forward rates for maturities in whole calendar months such as 1 month, 2 months, 3 months, and 6 months, but will tailor a forward deal to suit the customer's requirements. For commercial customers, banks usually give an outright quotation the same way as they give for a spot transaction. Thus, a quote like USD INR 3-month forward of 76.5220 slash 76.6210 means that the bank will buy $1 for rupees 76.5220 or sell $1 for 76.6210 for a delivery to be made after 3 months. There is a very active market for forward transactions. Interest rates, inflation rates, and exchange rates are related. Such relationships are referred to as international parity relationships. Interest rate parity. What is the relationship between forward rate and spot rate? The relationship between forward rate and spot rate is given by this equation where F is the direct quote forward rate, SO is the direct quote spot rate, RH is the home or domestic interest rate, RF is the foreign interest rate. Here is a numerical example. The 90 days interest rate in India is 2%, which means that the domestic interest rate is 2%, and the 90 days interest rate in the US is 1%, which means the foreign interest rate is 1%. The current spot rate for US dollars is rupees 75. What will be the 90 days forward rate? According to this equation, F can be worked out by plugging in the values of SO, which is 75, RH, which is 0.02, and RF, which is 0.01. We find that F is 75.74. This means that dollar would appreciate vis-a-vis the rupee over the next 3 months. Put differently, rupee will depreciate vis-a-vis the dollar over the next 3 months. Relative purchasing power parity. What is the relationship between the expected spot rate a year from now and the current spot rate? The relationship is shown by this equation where S1E is expected spot rate a year from now, SO is the current spot rate, IH is the expected inflation rate in the home country, and IF is the expected inflation rate in the foreign country. For example, the current spot rate for the US dollar is rupees 75. The expected inflation rate is 6% in India and 2% in the US. What is the expected spot rate of dollar a year hence? We have the values for SO, which is 75, IH, which is 0.06, IF, which is 0.02. Plugging in these values, we find that the expected spot rate for dollar a year hence is 77.94, which means dollar would appreciate vis-a-vis Indian rupee. The reason is inflation rate in India is higher than the inflation rate in the US. Expectations theory and forward exchange rates. If foreign exchange markets are efficient, the forward rate equals the expected future spot rate. Forward rate is equal to expected future spot rate. If the forward rate were less than the expected future spot rate, market participants would buy dollars forward, pushing forward rate upward till it equals the expected future spot rate. On the other hand, if the forward rate is greater than the expected future spot rate, market participants would sell dollars forward, thereby pushing the forward rate downward till it equals expected future spot rate. This has two very important implications. One, financial managers should not spend money to buy exchange rate forecasts, since unbiased forecasts are freely available in the currency market. Two, forward contracts are the most cost-effective way of hedging foreign currency risk. We can make the following observations about the foreign exchange markets. 1. Too often reports rationalize what has happened. 2. It is unrealistic to assume a stable cause and effect relationship between economic events and exchange rate behavior. 3. It is futile to look for news behind every exchange rate change. 4. Expectations change exchange rates as much as the exchange rates change expectations. This is George Soros's famous reflexivity principle. There is a vast array of financial services, deposits and lending, payments, insurance, investment banking or capital raising, investment management, depositories and custodians, credit rating, factoring and forfeiting, and many others. Driven by technology and competition, there are enormous innovations in the financial services sector, particularly in areas like payments, insurance, deposits and lending, capital raising, investment management, and market provisioning. The changes are of epic proportions and are dramatically altering the financial landscape. Financial system is being transformed by technologies. The important technologies are artificial intelligence and natural language processing, robo-advising, quantum sealed envelope, Bitcoin and blockchain technologies, big data and analytics. The principal regulatory agencies in India are Reserve Bank of India, which regulates the banking sector and non-banking financial companies, Securities and Exchange Board of India, which regulates the capital market, Insurance Regulatory and Development Authority, which regulates the insurance sector, Pension Funds Development and Regulatory Authority, which regulates the pension sector. What steps have been taken by the government and Reserve Bank of India in the last 3 decades or so to reform financial institutions and markets? Reform of banking, liberalization of interest rates, reduction in reserve requirements, increasing competition by allowing private sector players, advances in technology, prudential norms such as income recognition, provisioning and capital adequacy norms, standards for corporate governance, RTGS and electronic payments. Financial markets, repeal of Capital Issues Control Act 1947 and enactment of SEBI Act 1992, free pricing of securities, rationalization of the process of price discovery in the form of book building and auctions, computerized trading, dematerialization and rolling settlement, transparent takeover court. Stability of the financial system. According to Reserve Bank of India, financial stability would mean ensuring uninterrupted financial transactions, maintenance of a level of confidence in the financial system amongst all the participants, absence of excess volatility that affects real economic activity. RBI strategy for financial stability involves 1. Maintaining the overall macroeconomic balance, especially through the twin objectives of price stability and growth. 2. Enhancing macroprudential norms for the functioning of financial institutions and markets. 3. Strengthening microprudential institutional soundness through regulation and supervision. These are the key trends we have been witnessing in the Indian financial system. 1. Market determined interest rates and greater volatility of interest rates. 2. Emergence of universal banks. 3. Emphasis on prudential regulation and supervision. 4. Gradual integration with the global financial system. 5. Increase in financial innovation. While the Indian financial system has witnessed many positive developments, it is characterized by a serious structural defect on account of dominance by official sector for the last 5 decades. This has resulted in unfettered ownership of numerous intermediaries, mobilization of resources largely for governmental purposes, policy prescription on grant of credit. Public ownership has created an environment where market discipline has become perceptibly weak. The normal mechanisms that mitigate moral hazard in agency situations has been greatly weakened. In a book titled Pandemonium, The Great Indian Banking Tragedy, Tamal Bandyopadhyay has incisively analyzed the problems besetting the Indian banking sector. The key flaws in the DNAs of public sector banks in India are 1. Control over appointments, 2. Multiple channels of control, 3. Lack of independence of boards, 4. Political interference, 5. Perverse incentives and lack of accountability, 6. Conflict between social and commercial objectives, 7. Prevention of Corruption Act and vigilance inquiries. I have been fortunate to serve on the boards of financial institutions, asset management companies, and stock exchanges. I have also served on governmental committees on the capital market and the derivatives market. Based on my experiences, here are some reflections on the financial system. 1. Temptations in the financial world are many, and it is easy to succumb to them. Conspicuous examples: Harshad Mehta, Ketan Parakh, Rajat Gupta. 2. The ingenuity of the fraudsters is often 2 steps ahead of the capabilities of the regulators. 3. Often regulations have unintended consequences. 4. While foreign portfolio investment has been beneficial in many ways, it seems to have heightened the volatility of prices. 5. Banks and financial institutions controlled by the government have been used as socio-political institutions. We looked at the Indian financial system in some detail. Let us get a brief idea of the global financial system. The global financial system is a worldwide framework of legal agreements, institutions, and economic factors, both formal and informal, that together facilitate international flows of capital for purpose of investment and trade financing. The global financial system includes banks and financial intermediaries along with regulators functioning at the international level. The 3 major institutions in the global financial system are the International Monetary Fund, the World Bank, and the World Trading Organization. International Monetary Fund seeks to promote economic cooperation and ensure that international monetary system is stable. The World Bank seeks to provide loans to developing countries and also provides technical expertise. World Trade Organization seeks to establish and enforce rules of trade between nations. Globalization, corporate finance, and cost of capital. Financial markets are progressively becoming more globally integrated. Companies which are large and visible are able to attract global investors. Companies like Infosys and Reliance Industries Limited have been able to attract a lot of global investors. This has helped them lower their cost of capital in two ways. One, risks of equity are shared by investors with different portfolio exposures, different appetites for bearing certain risks. So equity risk premia have declined for companies which have global investors. Two, companies are monitored more closely by sophisticated investors. This inspires confidence among investors in general and lowers the cost of capital of such companies. Financialization, or the disproportionate importance of financial considerations in economic decisions, has been a defining feature of the economic history of the world in the last 25 to 30 years. The wave of deregulation that accompanied the new liberal agenda in the US, aided by the dominance of the US dollar and American economy, have resulted in the globalization of finance. China too has contributed to it. There has been a concern that the financial sector has grown disproportionately in the last few decades. In the last 4 to 5 decades, the finance industry in the US has grown significantly. Earlier, it accounted for 4% of GDP. Now it accounts for 8% of GDP. There is no theoretical or empirical evidence to support the view that this growth is beneficial to the society. One can argue that a part of this growth represents pure rent seeking. The disproportionate growth of the financial sector has caused a lot of animosity toward it. In fact, throughout history, people have despised financiers as parasites who have sponged off the real economy of agriculture and manufacturing. Numerous financial crises have persuaded people to believe that the financial world is the cause of poverty, not contributed to prosperity. The reality, however, is that advances in civilization would not have been possible without finance, money. Without money, we would still be in a state of primitive barter economy. Banking lies at the core of a modern economy. Banking enables channelization of savings to productive investments. Bond markets have facilitated millions of people to make relatively safe investments in securities issued by governments and corporates. Joint stock company has been a major innovation, enabling millions of people to have part ownership in large enterprises. Insurance has enabled people to handle risks that they would not have otherwise been able to do it on their own. Mortgage finance has democratized home ownership. Consumer credit has propelled growth in many economies. Poverty is not the result of rapacious financiers exploiting the poor. It has much more to do with the lack of financial institutions, with the absence of banks, not their presence. Far from being a monster that must be put back in its place, financial markets are like the mirror of mankind, revealing every hour of every working day the way we value ourselves and the resources of the world around us. It is not the fault of the mirror if it reflects our blemishes as clearly as our beauty. To sum up our discussion, the key components of financial system are financial instruments, financial institutions, financial markets, financial services, and financial regulators. The financial system performs several important functions: payment system, pooling of household resources, life cycle allocation of resources, risk management, price information for decentralized decision making, and dealing with incentive problems. Financial instruments are intangible assets that represent claims to future cash flows. The major financial intermediaries are commercial banks, public sector financial institutions, insurance companies, mutual funds, and non-banking financial corporations. A financial market is a market for creation and exchange of financial assets. Financial markets facilitate price discovery, provide liquidity, and reduce the cost of transacting. The key financial markets are equity market, debt market, derivatives market, and foreign exchange market. The equity market in India underwent metamorphosis in 1990s. The debt market in India is dominated by the government securities market, and the corporate debt market is relatively small. Derivatives are instruments such as forwards, futures, swaps, and options which derive their value from an underlying asset. Derivatives market, also referred to as the futures and options market, has grown phenomenally in the last 20 years. The foreign exchange market is a global marketplace for exchange of national currencies against one another. International parity relationships express the relationships between interest rates, inflation rates, and exchange rates. While the Indian financial system has grown significantly in size and sophistication, it has serious fault lines. The three key institutions in the global financial system are International Monetary Fund, World Bank, and World Trade Organization. Throughout history, people have despised financiers as parasites who have sponged off the real economy of agriculture and marketing. The reality, however, is that civilization would not have been possible without finance. If you have interest in learning more about the Indian financial system, you can consult this book, Indian Financial System, authored by Bharti Pathak. Thank you.